Thank you so much, everyone, for attending, and thank you so much, Davin, Hillary, and Catherine for organizing this amazing experience. I'm really happy to present my job market paper, my dissertation, which is about private equity fund valuation management during fundraising. So there are two research questions in this paper. One question is, do private equity general partners, which are called the GPs, inflate current fund performance during fundraising periods? And the second question is, if so, how are they able to achieve this? So to put a little bit of a context of what my research question is, what really is about, is consider this typical private equity fund called Fund 5. And this is a closed-end fund with a fixed life of about 10 to 12 years. And for the first half of this fund's life, they would raise or seek investment opportunities and invest in some of them. And for the latter half of this fund's life, they would exit these portfolio firms or their investments, hopefully at a higher price. But now, because these funds are closed-end and they have a fixed life, what the GPs, who are the managers of this fund, need to do is they need to go out, raise their subsequent fund, such as Fund 6, in order to maintain themselves in business and operation. So what naturally the GPs would do is around years 5 to 7 of Fund 5's life, they would go out fundraise for Fund 6. And what naturally becomes important is the valuation of these current Fund 5. And so during these fundraising periods, what the researchers or academics in private equity literature has found is that they have these abnormal net asset values or valuations during these fundraising periods. And they have been debating whether these abnormal valuations are coming from the GPs manipulating the fund valuations or themselves just timing these fundraising periods when the fundraising or the performance is at its peak. And my contribution to this stream of literature is to study how this is able to occur, and I do so by decomposing the NAVs into two parts. One is the valuation multiples that are used to value these portfolio firms, and the other is the financial performance of these investments. And to put a little bit more in detail about this, consider this real-life fund called CVC European Capital Partners 5. And this fund invested in a bunch of portfolio firms, such as the Servit Group, Virgin Active, and Allcell. And one of the most common ways to value a portfolio firm is to apply certain valuation multiples to the portfolio firm's financial performance. So for example, if you look at EBITDA of the Servit Group, which had about $150 million, and if the GPs decide to apply a valuation multiple of 6 times, then the valuation of Servit Group is going to be $900 million. And if you do this and aggregate them across all the portfolio firms of this fund, the NAV of this fund is going to be $3.8 billion. Now, as you can see here, there are two dials which the GPs can turn. One is to inflate the financial performance of the portfolio firms, conducting activities such as earnings management, which I'll get to in a little bit more detail, and also manipulate the valuation multiples of these portfolio firms when they value the portfolio firms. So this is the crux of my dissertation here. Now, overall findings, I do find that during fundraising periods, low reputation funds inflate valuation multiples and also manage earnings of their portfolio firms. And I hope to make 3 contributions to the academic literature. First is to the private equity literature by showing the mechanisms behind this documented NAV inflation during fundraising periods. Also, I would like to contribute to the valuation multiples literature by showing that managerial discretion, reputation, and fundraising motives could also inflate the multiples. And this is something that's been distinguished compared to a public firm setting, given that in a private equity fund setting, the GPs or the managers are able to actually inflate these multiples. And also to the earnings management literature, I contribute by exploring the dynamics of earnings management in a private firm setting, which is economically important. For example, they outnumber public firms 18 to 1, but also structurally different in the sense that they have different ownership structures with a much concentrated ownerships. So there are 2 hypotheses in this paper. One is asking whether the GPs inflate valuation multiples, and there are 2 reasons why the GPs might do so. One is that theory predicts some NAV inflation or that valuation management for at least a subset of private equity funds. And also GPs calculate and report NAVs using their own assumptions and valuation methods. And one of the most common ways, as I've mentioned, is to apply these valuation multiples, but which valuation multiples to use or which proxies to use, these are all under the GP's discretion. My second hypothesis talks about whether the GPs have the ability to manipulate the portfolio firm's financial performance. And they could do so in three distinct private equity transaction characteristics. One is through the high level of equity ownership. For example, private equity transactions involve more than 50% stake in a portfolio firm. They also have board memberships, which are known to meet more frequently than public firm boards. And also by replacing management who has incentives aligned with these portfolio firm managers and the GPs. So the two hypotheses is that when fundraising, GPs have the ability to inflate the NAVs by inflating both valuation multiples and by inflating their firm's financial performance. So to test my hypotheses, I use a sample of firms in Europe and the buyout funds that invest in them. A couple of big advantages of these having a European setting is that Europe is many of the European private firms are required to disclose their financial statements, so I'm able to observe all the detailed financial statement information of their portfolio firms. And also, Europe is the second largest private equity market in the world. So my sample is a match between a private equity data set, which is called Preqin, and financial statement information from Amadeus. I also partition each sample by GP's reputation because the prior literature has identified reputation as an important source of whether these funds will actually manipulate or time their fundraising periods. So my regression here for my first hypothesis is to regress the natural log of NAV, the valuation, divided by the sum of firm performance on this fundraise flag indicator, which equals 1 if the given quarter is -4 to 0 quarters relative to the subsequent fund's fundraise close quarter. And also, for the second hypothesis, I regress one of the earnings management variables in the same fundraise flag. And note that this earnings management variable is more about these firms or the firm managers. It's not anything illegal or something fraudulent, but it's more about the managers trying to inflate the earnings or their financial performance in the short term using accruals or other real earnings management activities, and in the long run, they would get hit by the fundamentals. So figure 3 panel A here shows the results of my first hypothesis. And the x-axis here shows the quarters relative to fundraise close. As I mentioned, -4 to 0 quarters is noted as the fundraising quarters. And the y-axis here is the valuation multiples. And the blue line is the valuation multiples for the low reputation funds, and the red line is for the high reputation funds. And as you can see here, there's a sharp run-up of these valuation multiples during fundraising periods. In a regression form, it's about 20% increase compared to non-fundraising periods. And as you can see in this red line, I don't find any evidence of inflation for high reputation funds, which is consistent with prior literature. And also in table 5 panel A, I test my second hypothesis, and I find that firms under low reputation funds have about 3.8 percentage point higher abnormal accruals and 13.5 percentage point higher abnormal production costs scaled by firms' total assets. And this is consistent, again, with my hypothesis that some portfolio firms of these low reputation funds are using earnings management to temporarily boost their financial performance. And I do not find any inflation for firms invested also by high reputation funds. I do have a battery of other tests that I wish I had more time to discuss, but the earnings management results do not hold for minority or venture capital investments, which are known to have much less influence for one investor to the portfolio firm. My results are also robust to many alternative explanations. For example, my results are not from timing their fundraising, the GPs improving their investments operating performance, motivations for exit, and also some measurement error. And in later tests, I also do find some evidence of successful fundraising when some forms of real learnings management is used, which is actually in contrast to prior literature, which find that most of these manipulative activities do not go unnoticed, and they do get caught, and these funds are not actually successful in fundraising. So thank you so much for listening, and I'll open up the floor for any questions. Thank you so much.